Overview of the economic impact of the Israel-Iran conflict and its implications for market futures. Economic impact. Oil prices surge. The conflict has caused oil prices to spike dramatically, with Brent crude rising over 10% to as high as $75.15 per barrel at one point, the highest level in nearly 5 months. This reflects fears of disrupted oil supplies from the Middle East, a region responsible for a significant share of global oil production and exports. Iran, despite sanctions, remains a major oil producer and exporter, particularly to China and India. Any disruption to Iranian output or shipping routes, especially through the Strait of Hormuz, which handles about 20% of the world's oil, could have systemic global consequences. The spike in oil prices is expected to push up fuel and transport costs globally, leading to inflationary pressures and higher costs for consumers and businesses. Global markets and investor sentiment. The conflict has triggered a sharp risk-off sentiment among investors. U.S. stocks fell sharply, with the Dow Jones down about 1.8%, the S&P 500 off 1.1%, and the Nasdaq dropping as much as 1.3% at session lows. European and Asian markets also opened lower, with Germany's DAX experiencing significant declines. Investors have shifted funds into safer assets such as gold, up about 1.5%, and government bonds. Sector performance. Energy stocks, such as Chevron and Exxon, have outperformed as oil prices surge. Defense contractors have also seen gains, with companies like Rheinmetall and BAE Systems up 2 to 3%. The travel and leisure industry has suffered, with airlines rerouting or canceling flights due to airspace closures, increasing costs and travel times. Shipping and supply chains. The conflict has raised concerns about disruptions to global shipping routes, especially if Iran retaliates by targeting vessels in the Red Sea or Strait of Hormuz. This could lead to increased shipping insurance costs, delays, and higher freight rates. Major shipping companies may reroute vessels, further raising costs and extending delivery times. Market futures outlook. Short-term volatility. Market futures are expected to remain volatile as long as the conflict persists or escalates. Any further military action or retaliation could trigger additional drops in equities and further spikes in oil and gold prices. The S&P 500, which had recently broken through the 6,000 mark, fell below this threshold as the conflict escalated. Long-term risks. A prolonged conflict could lead to sustained higher oil prices, renewed inflation, and slower global economic growth. Central banks may become more cautious about cutting interest rates if inflation driven by oil prices persists, potentially delaying monetary easing in countries like Australia and the U.S. Emerging markets and oil-importing countries, such as India, Pakistan, Indonesia, and Bangladesh, are particularly vulnerable to supply disruptions and price shocks. Summary table. Impact area effect. Oil prices surged over 10%, highest in months. Stock markets U.S., European, Asian markets down, energy, defense up, travel, leisure down. Safe havens gold and government bonds up. Shipping risks of disruption in Strait of Hormuz, Red Sea, shipping costs and delays may rise. Inflation higher fuel and transport costs, inflationary pressures. Central banks may delay rate cuts if inflation persists. Summary. The Israel-Iran conflict has led to a sharp rise in oil prices, global stock market declines, and increased volatility. The outlook for market futures is cautious, with risks of further disruptions to oil supplies, shipping, and global supply chains, as well as potential long-term inflationary pressures.